Back with closing trades, the markets are holding up absolutely flat. Not much happening right now. It's a range-bound trading session for our market. But yes, we've seen a little bit of a spike up coming in, but we continue to hover around the 26,200 mark. Let's get into a fundamental conversation about where the markets could be headed. What are some factors that you should be watching out for as we wind down 2025? We have Mr. Siddharth Vora, Head of Quant Investment Strategy and Fund Manager at PL Asset Management, joining us on the show. Siddharth, apologies about earlier, and thanks so much for your time today. Give us a sense of where you're seeing the market headed as of now, given that we've been absolutely range bound. But yes, off late we've seen some recovery. Do you believe that this is just the year-end cheer, or do you believe there is actually some fundamental strength that is returning in a market that has been range bound for a very long time now?
So I think India is genuinely looking like it's set up for a good constructive cycle in terms of domestic equities. And there are multiple factors, coming together at this point of time. If you really look at it, the macro is really strong from a growth perspective. We're in a low inflation environment. The monetary and fiscal policy in terms of, rates and taxes is very supportive. So I think this is favorable. From a quantitative indicators perspective, the risk appetite bottomed out around Feb, and since then it has been steadily but gradually rising. So the risk appetite is healthy, coupled with low volatility. So the uncertainty of fear currently is quite low. The earnings downgrade cycle is pretty much behind us, and we've entered an earnings upgrade cycle. So from a growth perspective of corporate India, again, things are looking good. Crude dynamics are favorable. Another important point here is the relative valuation of India, versus emerging markets, developed markets, gold and silver have hit pretty much cyclical troughs. So when you're looking at a market with the best in class growth metrics, very stable, steady macro, and low relative valuation, I think it makes a really good case. And we obviously can't forget the whole anti AI trade. So India never participated in the whole crypto and AI rally. But now, as the crypto and AI rally is unwinding, I think India is a good neutral market for foreigners to allocate amidst the entire meltdown in AI and crypto.
Okay, so that's the consolidated view on the market right now. But Siddharth, you did say that we're set up for a constructive cycle going ahead, and you also spoke about some of the tailwinds that are headed our way. Do you believe FIs are also sharing this view right now, or they're starting to change the thought process towards this direction, given that we've seen absolute lackluster FI buying? In fact, we've seen so much selling. It has come back to some extent in the last 2 or so days, but that also fizzled out quite quickly.
So
What is your take over there?
So I don't think FII buying is currently meaningful. It continues to be a source of risk for India, but we need to, cheer our domestic investors for keeping our markets steady, stable, and resilient. And it's only a matter of when and not if when foreigners come back to India. So, as I said, there's a confluence of multiple factors in terms of earnings, valuation, domestic liquidity, macro, geopolitical stability in India that makes India a very good structural long term story. Of course, the medium term and long term outlook continues to be great. In the short term, we do see multiple risks. The Japanese yen carry trade unwinding, that is a potential risk. The weakening INR, some breadth measures still continue to be a little weak as of now, but they are turning up. So in the short term, we could see some improvement in broad-based participation in India as well. And I think the bigger risk for the next 5, 7 years is that India does lack any meaningful AI play. So that is the only major risk that could, keep FIIs away. And of course, the trade deal, it's getting delayed. So that's an overhang. Hopefully, it gets resolved with time. So overall, we do see there are risks, but I think the risks will eventually, resolve over time, and foreigners will have to look at India for its, breadth, strength, the size of the economy, and the stability of macros. So we're looking good.
And Siddharth, amid a market like this, where do you think the portfolio bias should be? Should one be playing it safe with the larger cap names right now? Or do you believe that the valuation correction, if at all we've seen in the mids end of the basket, makes that end more attractive? Where would you be placing bets in your portfolio?
So our portfolio currently we are 85% large and mid caps, less than 15% small caps. Small caps, honestly, from a valuation perspective and from an earnings perspective, they've disappointed on growth, and the valuations are not cheap anyways. So we are more comfortable, and our models are also capturing better opportunities in large caps and mid caps, either where growth is very strong or where valuation is very comfortable. But small caps, most of them are not fitting that bill of as of now. And currently, our style orientation, so we are a style adaptive strategy. So it keeps changing style orientation based on the market cycle. We're currently running a value orientation since March, April. Prior to that, we were running a quality and low vol orientation for like 9, 10 months. And prior to that, we were running a momentum orientation for 12 months. So our style orientation keeps changing. Currently, our portfolio is tilted towards value. And we're more bullish on sectors such as materials, metals, energy, commodities, basically high beta cyclical sectors. And we also have meaningful allocation within the entire financial space. So financials, materials, and metals have been the dominant part of our portfolio. So we do have a cyclical tilt.
Okay, and where in your portfolio, Siddharth, does consumption find a place, given that the GST play is now gradually playing out the GST cut rationalization that we've seen? What about consumption, amid consumption, is it discretionary, staples, or then are you looking at auto, perhaps real estate? What's looking good over there?
So we have a roughly 13-14% allocation to auto, and as a defensive allocation within the rather aggressive portfolio that we are currently running, we've started entering pharma and IT as the defensive place rather than domestic consumption. So we're not playing the traditional consumer stories. Auto is literally the only consumer exposure we have in the portfolio for now.
Okay, and so that very interestingly, you spoke about pharma. Just want to understand, within pharma, are you going with the CDMO play that has been a common preference for a lot of managers right now, or are you looking at the new semaglutide space that's coming up? We've got Sun Pharma over there. Zydus has received approval today to launch their own semaglutide drug. Cipla has a play over there. What's looking good? Is that a space that you're looking at right now?
So we currently own, Lupin and Dr. Reddy in the portfolio, and we are still, evaluating the broader pharma space, and gradually we'll build some positions there. But too early to say because we've just started, entering pharma.
And metals is something you like. You spoke to us about that. Within metals, do you have a view, and do you own precious metals as well, gold and silver, given the kind of rally that we've already seen this year in both of those commodities?
So, within our, we run two strategies. One is a flexi cap equity strategy, and one is our multi-asset strategy. So, in our flexi cap equity strategy, we have roughly 20% allocation to metals, including ferrous and non-ferrous. And we've maintained this position for over 6 to 7 months. So, I think that's played out pretty well for us. In our multi-asset portfolio, we have increased our gold allocation roughly 17, 18 months back, from 10% to 30%. And we continue to ride that 30% allocation in gold since the last 18 months. And I think that has not only given us a good hedge, but a great diversification in a cycle where Indian markets have gone nowhere. And our gold allocation has really done very, very well for us in our multi asset strategy.
Okay, so that's appreciate that view, and thank you so much for taking the time out and speaking to us today. Good chatting with you. Okay, viewers, on that note, we'll slip into a very short break. On the other side, we'll continue the conversation around the technical setup in the market. We have Akshay Bhagwat, who's been waiting by with us, so we'll keep that conversation going just on the other side of this short break.